following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host, David Blain. Thank you for joining us today on 94.1 FM WNBU, as well as cable TV 10 in New Bern. We're glad that you joined us today. We've got a good show lined up for you. We also thank Bob Register there for being our engineer on the show. He does a great job for us. And we'd like to hear from you, our viewers and listeners, what topics you'd like us to talk about, any comments, questions you have. We got lots of ways to get in touch with us. Of course, we have a phone number, which is 252-633-0107. You can call us, give us your feedback. You can also email us directly to the show here at allthingsmoney@dlblain.com. And of course, as most people seem to do these days, you can head to our website at dlblain.com, the big Contact Us button there. You can hit that and send us a note. Okay, I thought we'd start off today with a little bit of an economic review, what's going on out there in the world. I know that for the week that ended on Friday, the S&P 500 was down about 2.1%. So the S&P 500 is an index of the 500 largest companies in the United States, if you didn't know. And so the year-to-date return is still plus 18%, but in the last week it lost 2.1%. We saw some volatility a month or two ago, and people are starting to get nervous. You know, what's going on? Well, I'll tell you one thing. The market has gone up since 2009. Depending on which index you look at, there's not been a 20% correction in the market since 2009. And if you line that up, at least in the U.S., that's the fourth longest bull market in history. I think I mentioned this last week, but there's still a lot of people that I see come into the office or walking around town, and they're still nervous about the financial recession and waiting for the whole banking system to collapse and things like that. And they wouldn't touch stocks. It's too. They just missed the fourth longest bull market in history. And it just, once again, the people that advocate some sort of timing of the market and things like that, it's almost impossible to do. Even if you were able to get out in 2008, a lot of those people are still waiting to reinvest, and they've missed out on literally hundreds of percent gain. The market goes in cycles, and so the ups and downs are what you get paid for. A little story that I like to tell is, if you're in a career, you're a doctor or you're a lawyer or you went to college, or maybe you grew up in a poor household and you struggled to even get through high school. You had to earn money to keep your parents and contribute to the rent and things like that. But wherever you are today, if you're successful, more than likely it's because you went through some sort of struggle. You had to pay a price. You've heard that. An athlete or whoever had to pay a price. Well, investing, if you want to make more than nothing on short-term treasuries today, the interest rate is very low. If you want to make more than that, or make more than what is considered a sure thing or some sort of guaranteed income, of course, it doesn't take into account inflation, but that's another story. You have to be able to be willing to endure something. And investing, the pain that you have to endure to be successful is you have to be willing to have your portfolio go up and down in value. Now, if you're out there picking individual stocks, you're trying to pick the next Apple and things like that, you have to be willing to lose all your money. If you pick Enron or MCI WorldCom or some small company, part of the pain you have to go through is you have to be willing to lose it all. You have to be willing to have that company go bankrupt. GM wiped out shareholders. Chrysler's wiped out shareholders. Those type of events. Now, if you're investing in broadly diversified mutual funds or index funds or something like that, you can eliminate that risk of any one particular company going out of business, which is what we advocate. Just that risk, there's a lot of debate whether that risk is adequately rewarded. Maybe 20, 30 years ago, the answer was yes. I think today, the majority of people that understand the way markets work, that understand the current investing climate would say no. Certainly on a short-term basis, yes. You know, does Apple outperform sometimes? Does Exxon do better? Sure. But in aggregate, picking individual stocks is extremely, extremely difficult. And in the end, the majority of people do not end up outperforming a normal benchmark. In fact, if we have time, I'm hoping that in some of the later segments today, we're going to talk about some of the performance of mutual fund managers versus the indexes. A good study that just came out, Dimensional Fund Advisors looking at some of the Morningstar ratings and things like that. Well, I don't want to get off track. So part of the pain of investing and what enables you to make more than an average rate of return of, say, the Treasury bonds is you have to be willing to endure something. And we're starting to see some of that volatility here over the summer. And as I mentioned last week, the market lost 2.1%. Now, why was that? There's a lot of reasons. People on TV will point to this reason or that reason. But the reality is there's nothing that you can point your finger to. I mean, one job I would hate to have would be a market analyst for a newspaper or CNN, because every day when the market went up or it went down, you would have to come up with some plausible reason why on a daily basis the market went up and down, when in fact the majority of the movement, especially in the short term, is random. It'd be an awful job to have to think up something every day. Well, having said that, we do want to look at some of the data that's coming out here, and the retail sales, which had inched up 0.2% in July, was the weakest indicator for growth for the U.S. consumer since April. On the heels of a 2.9% increase in June, this number looked pretty weak. Sales of motor vehicles, auto parts fell. Your large home furnishings and things like that fell. So that gives a little bit of concern. People think that some of the consumer spending, especially on your bigger ticket items, may be slowing down, and that's going to dampen some of the enthusiasm for the market going forward. We also saw core retail sales climb 0.5%, not a huge gain, but it was the largest since last December. So we do see some gains, but those big ticket items are really slowing down. Well, that brings us to the end of our first segment. When we come back, we'll continue talking about some of the economic data that's coming out today and if it means anything for your portfolio.